on with each of the 4 subjects which we will cover. And those 4 subjects are C2, COVID-19, IFRS 17, and sustainable finance. My name is Tony O'Riordan. I am chair of the Insurance Committee of the Actuarial Association of Europe, and I'll be joined by Siegbert Baldauf. Siegbert is chair of the Solvency II Working Group of the Actuarial Association of Europe. He's an experienced actuary, having worked in Germany across tariff, accounting, economic valuation, and he will talk with us on Solvency II. I will speak on COVID-19. Christopher is a director with KPMG, delivers consultancy services into the financial sector, and has long experience with the AAE, and now chairs our IFRS 17 working group. Christopher will speak on IFRS 17. And Larry Sarast is the ALM director at Local Tapiola in Finland. Larry is vice chair of the Insurance Committee, soon to be chair, and is also on the Insurance and Reinsurance Stakeholder Group of AOPA. Larry will speak on sustainable finance, and of course there have recently been 2 consultations at AOPA and EC level on sustainable finance. So we will talk for the session will last 2 hours. We'll leave hopefully 15 minutes at the end for questions. I should say the webinar is being recorded and will be available to registered members on the AAE website. And I would encourage you, there's a chat facility. I'd encourage you to please use the chat facility to record your questions as we go through, and we will deal with them as best we can, time allowing. So I'll pass over straight away to Siegbert, and I think we have a good group and a good group scheduled to be with us today. So looking forward to a good number of sessions. Thank you.
Do you want to pass over to me?
Yes, I am trying to, here we are. I've tried to find you actually, Siegbert, so I have now found you.
Okay. So, what happened? Is it clear?
Now you closed it.
Yeah.
Yeah.
Can you see the presentation here?
Yes, but it's very small.
I opened it as a clear presentation, so
okay.
Better now?
Yeah.
Okay, then let's start. Yeah. Hello, good morning also from my side. I have the pleasure to talk about Solvency II 2020 review. As you remember, there are hundreds of pages published on this issue, so I had to decide what I can present you in this webinar. I have split the presentation in 3 parts. First is a kind of stock-taking exercise. Then I will talk about some of the issues where EIOPA's advice becomes or seems to become apparent, and something about Commission's own initiative. So let's start with some kind of stock taking. We're first dealing with the process. The process is as designed in the Article 77F of the directive. Even if we are not only talking about LTG, it's a far further reaching review and perhaps also extension of the Solvency II framework. The process is defined by this Article 77F. So we have first the task of EIOPA to deliver reports to the Commission. Then the EIOPA will submit an opinion to the Commission that is scheduled for end of December 2020. And then Commission will submit to the European Parliament and the Council their report. And this report will also talk about changes or will propose changes of the framework. And then we are in the political process. This process is in line with the Treaty on the Functioning of the European Union, and it happens in a predefined way. As the Solvency II directive is a level 1 document, this document has to be approved by the trilogue parties. Some of you, being longer in the business, might have in mind the process relating to the Omnibus II directive in 2014. It's a similar proceeding can be expected here. After the approval, these changes of the directive have to be transferred to national law in all of the member states. And in addition, it might be necessary, if you change the level 1 document, you might also be forced, or there might also be some empowerments to change delegated regulation or other standards. And what about becoming effective? If you are looking at this, you can't expect a transfer to national law and a coming into force in the countries before 2023. The question is if EIOPA wants to accelerate this like they had done earlier with a kind of preparatory use. Sorry. So just as a reminder, the Commission had asked 19 questions or had requested advice on 19 items in 2016. I don't want to go through this, it's just to remind you, you can read it afterwards. We are especially interested here in this part relating to LTG, its extrapolation, volatility adjustment, transitional, and some of the other issues, but I will focus on only a few of these relating to the structure of the risk-free interest rate and to some aspects relating to the risk-free rate curve. We are not starting from the scratch. There's a lot of paper available, and when I talked in the beginning of hundreds or even thousands of pages, all of these papers, I have just listed some of them here on this slide, have been prepared as a kind of preparation for this comprehensive review that has been started in 2019 with the request of the Commission. It's about the LTG reports. It's an ongoing process. We have seen already 4 of them. Then we have some new aspects that are already by now not covered by the Solvency II framework. It's about macro prudential issues like systemic risk, or in the blue boxes on the left of this page. Then it's become aware that insurers' assets and liabilities might be different from those of banking institutes, and especially the illiquidity of liabilities has been an issue. Okay, then we have this ultra low negative interest rate scenario for several years now. And so, okay, the Commission will take note, or EIOPA will can be expected to produce their advice based on these papers, or at least making use of these papers. And the Commission is willing to also accept additional things when it comes to their report of the Solvency II framework. So a Commission is doing some kind of following some kind of dual track policy. We have on the left-hand side here the technical advice, request for technical advice that has been sent to EIOPA. But in addition to this, Commission had started an own consultation, a review of prudential rules for insurance and reinsurance companies. It has been published in July 2020, and there is a deadline. I will come back to this a bit later on in October. And this all will be used to produce Commission's. Sorry, I've been too early. Produce Commission's proposal for the Parliament and the Council. And the roadmap here has been changed. Normally, it had been expected by 1st of January 2021, but COVID-19 and other issues led to a shift of this date to the 3rd quarter of 2021. So these are the papers that have been produced. We have the consultation papers here on the left-hand side. There are 3 of them that already are directly linked to EIOPA's opinion. And then we have started this year holistic impact assessment. We had 2 data requests or information requests published by EIOPA, the first one in March and the second one in July. And so all together, this will be the basis for EIOPA's opinion. what we have to consider now, when we dealt with this in our working group, we had to see that it is not that easy to produce a kind of one-fits-it-all solution for all of these issues. The differences in the countries, the differences in the business models or in the legal background can be illustrated by just looking at one slide or one table in the LGG report 2019. It shows the use of long-term guarantee measures across countries, where you see some are only used in one country, like the DBER, or some, like the volatility adjustment, are used in 22 countries. And so it differs considerably, and that makes it not easy to produce comments or to find solutions that leave room for other solutions that might be available or prevalent in the countries. Now, the advice becoming apparent. Why have I chosen this title? When we looked at the consultation papers, especially with regard to extrapolation to volatility adjustment, EIOPA has prepared an extensive discussion of these issues. They have discussed deficiencies, they have presented options, and they have presented a lot of analysis relating to these issues, but no concrete advice concerning a preferred option. And there is already some advice in it. If it comes to, for example, the volatility adjustment, it's just an extension of risk management. And it has been an advice not to change the risk margin calculation. And now, when it came to the holistic impact assessment, we have seen something different. We have a preference of EIOPA for for specific options. In the scenario EIOPA tested in March, they have some changes of the baseline scenario. It stated the reference date has been 31st of December, and these changes are related to the extrapolation. They now proposed the alternative extrapolation methodology that had only been 1 out of 5 discussed in the consultation paper. And so they made proposals for volatility adjustment, for long-term equity and these issues. And they have again tested or asked for complementary information in their complementary information request from 1st of July. And this has been the reference date of 30th of June 2020. And one of the background of the ideas of the hopes is that there might be some aspects visible resulting from the COVID-19 pandemic. So what has been, and I want to focus, as I mentioned earlier, on those issues relating to the risk-free rate curve. And the basis for all of these issues, a basis for this, is the analysis of the deep liquid transparency of markets. And what EIOPA did, it has been they have been asked by a commission to do this, and they analyzed markets with regard to the traded volumes or with regard to the availability of papers of financial instruments. And so they came to the conclusion that swap markets, only analyzed for 2016 and 2017, show some deep liquid transparent markets also for durations of 25, 30, 40, and 50 years. In bond markets, it was not possible to assess the availability of Dutch papers due to not available data. Then they analyzed the matching criterion, and this matching criterion led to the LL last liquid point results of between 10 and 23 years. If you look at this, mostly it is between 10 and 15 years, and it has been some kind, might be an outlier with the 23 years in 2018. And then an important issue that is used now, again, is the residual volume criterion, where they tried to determine the outstanding volumes of bond cash flows it's calculated here. The data is calculated with a threshold of 6%. There are also data for thresholds with 3% or 12% in the consultation paper. But all over this, yeah, and it has been used now to propose a change of the extrapolation methodology in order to take account of the liquid markets post the current last liquid point. The current methodology is here listed on the left-hand side. We have the last liquid point, and especially if you look at the euro, that is also one of the concerns of EIOPA. We have in the Omnibus 2 guideline a separate treatment of the euro. And it's, of course, it's not very good, not very convincing to have different treatments when it comes to the treatment of different currencies. So it would be great, perhaps, to have a uniform treatment of all of these. And while the current methodology for the euro has a defined last liquid point, has a convergence point of 60 years, has a convergence tolerance of 3 base points, and has a predefined credit risk adjustment and an ultimate forward rate, and the extrapolation is done by use of the Smith-Wilson method. The alternative methodology now starts with the first smoothing point of 20 years. It's derived from the residual bond criterion. They are defining a last liquid forward rate that is depending on weights and forward rates after the DLT, after the last liquid point or the first smoothing point. And the methodology now is to calculate the forward rates as a kind of weighted combination of last liquid forward rate and ultimate forward rate. An important issue, an important parameter in this context is the mean reversion factor alpha contained in the formula. And what is also different from the current methodology is we don't have a prescribed or a predefined convergence tolerance or a convergence point. I have here the outcome, the sensitivity with regard to the alpha. If you have an alpha of 0.01, also almost 0, then you will have a flat rate until the end of the projection period of 150 years. If you have the 2%, it is the orange or brown curve here, and this factor that is used in the Netherlands for pension business, you have this curve, and the blue one is the 10%, and I added in addition the 15%, and the 15% comes pretty close to the yellow one, or kind of yellow one, that is produced in the old methodology. So there is a huge dependency on the chosen alpha, and there is no you can't substantiate really a choice of alpha. Instead, if you compare it to the current curve that has been produced by the existing methodology. So now, in the second, in the complementary data request they have launched in July, they asked in addition for a calculation of with a curve with a last liquid point of 30 years. And if you look at these 30 years, you see a strange bow downwards in the years 25, 31, and then it's going up. And this curve stays even below the alternative extrapolation method. So you could think about a kind of framing or something like this in this context, no? But it's clear that this 30-year would lead to significant challenges for undertakings, and it's a really significant pressure on the capitalization of the undertakings. So this is an issue that has to be analyzed. Then we come to the extrapolation method. The AAE's view on this. We have discussed this, and we came to the conclusion that we could not support a change of the last liquid point for the euro, and that is because we don't have, we can't use swap for every purpose in the undertakings, we do need bonds to cover some liabilities, and EIOPA has not shown the effects of in crisis situations, or what would happen in a case where we have significantly higher interest rates like we had in the year 2000 or earlier. Then we will have a change in the calculation of the floating leg of swaps, the IBOR transition. Then we have the impact of ECB's asset purchase programs, and it has a huge impact on the interest rates, and that becomes apparent in case you don't have a fixed convergence point. And then this again a consequence of the non-availability of convergence points or convergence tolerance. The ultimate forward rate is the importance of the ultimate forward rate is weakened. So let's move short to the volatility adjustment. In that case, EIOPA asked for to analyze two approaches. Approach one was based on the representative portfolio as it is now, and EIOPA is asked to take account of the liquidity features or duration of insurance liabilities. And the approach two is based on own assets of undertakings. We had been in favor of the approach two. And what we have also observed is we do have different supervisory practice. In some countries, you need approval if you want to use volatility adjustment. In others, you don't. So this is also a kind of supervisory divergence. The formula that is now proposed by EIOPA takes in account the mismatch in fixed income assets and liabilities as an application ratio 4, and the liquidity characteristic via an factor AR5, application ratio 5. And okay, we have this global general application ratio and then scaling factors and risk corrected spread. And so it's even if we stick to the representative portfolio, we have to acknowledge that we do have to consider undertaking specific aspects when it comes to the determination of the factors application ratios 4 and 5. And in the complementary information request, they introduced the factor omega, and this factor omega has to should reflect the should be used to substitute the current treatment of the country component. So this is an issue that has been now. It will not lead to a fixed parameter as it is now with the 85 base points, but will have a kind of moderate stepwise process. I mentioned earlier that in the consultation paper, the risk margin, it was EIOPA's advice was not to change the risk margin and the risk margin calculation. But now in the holistic impact assessment, they have introduced a factor lambda, and this factor lambda is used to reduce the impact of the SCR of T in the future years. So it is a kind of comparable, the effect is comparable, especially for long-term business, to a reduction of the cost of capital rate. What we have also seen is we still have the kind of binary character of the risk margin. As soon as you have you hedged your business, you don't need the risk margin, and but you have to use the full risk margin in all other cases, even if you do have some kind of partial hedges. The interest rate stress is another issue that has been analyzed here in the working group, has been discussed in the working group. One of the criticisms we had earlier is that we also have a stress of the ultimate forward rate planned here, and we didn't see that this is in line with the 1-year horizon that is required in the Solvency II framework. So it cannot be expected by a stress in 1 year that the ultimate forward rate would change significantly. So these are very roughly. And next came a Commission's own initiative. And this initiative made clear what Commission wants to consider. It's here in this box on the right side of the slide. They want to also to have some positive contribution to the European Green Deal, completion of the Capital Markets Union, and strengthening of the single market. And it should be flexible. It's a kind of, it looks a kind of like squaring the circle, but that is some information that has been given by the Commission in their review paper. They are discussing several issues in their consultation paper. It's a higher level. It's not that as technical as the EIOPA papers are. And they are discussing some issues that might not be of high priority for actuaries, but nevertheless, we try to analyze these, and especially long-termism is one of the issues that has to be considered. Proportionality, okay, transparency towards the public. It's a kind of discussion we had in relation to solvency and financial condition report and these issues. Improving citizens' trust and new emerging risk is, of course, an issue that has to be is of interest to actuaries. And a Commission mentioned also some goals and concerns. They want to prudential Solvency II should provide the right incentives for robust risk management while avoiding excessive risk taking, avoid procyclical behavior, not unduly prevent insurers from contributing to the long-term financing of the economic recovery of the EU. That are partly political issues, and they have also mentioned some concerns relating to the unprecedented environment of low interest rate, which is progressively deteriorating the profitability of insurers. And okay, despite the prudential framework, you can read it on your own, it can incentivize insurers to search for yield. That is an issue, has been discussed over the last years. And the low interest rate environment can affect the life insurance landscape and the ability of insurers to offer insurance products with guarantees. The current trend to risk shifting to policyholders can result in new challenges depending on customers' risk tolerance and financial literacy. It's a question also in this review paper of the Commission where they ask if we can observe some shifting of conventional products to unit-linked products, so shifting the risk to the policyholder. And what were we doing as Solvency II working group? Yeah, that's roughly speaking, we want to monitor all upcoming activities relating to Solvency II Review 2020. We will respond to consultation or discussion papers relating to Solvency II. We will, in addition, develop own views on actual issues of high importance within Solvency II. And our next important activity is commenting on EU Commission's paper that I've mentioned before. So, and that's what I have prepared as slides here, and I hope I'm within my 25 minutes, but I'm happy to have your comments or questions.
Siegbert, thank you, and you are pretty much on time, so that's great. And I would encourage people just to think of and put down questions as we go along. There is one I'd just like to ask very briefly, Siegbert, and we can come back for a more detailed response if there is time. But how do you see the risk of the UFR being unrealistic, and by that it would increase the risk of systematic losses due to under-reserving? Do you consider that there is a significant risk of that?
We had this discussion already in the year 2017 when EIOPA developed their new methodology to calculate the ultimate forward rate. And so the methodology that had been introduced at that time, we had agreed that it's not only an actuarial issue. It is hard to anticipate what will be the conditions that are prevailing when insurance undertakings try to invest 60 years from now. So that has been a challenge. So we finally agreed with the methodology that had been proposed by EIOPA, taking this widening window approach, starting with available data on real rates and the ultimate forward rates combined as a sum of a real rate and of the inflation target of the European Union. And so it's clear nobody knows what will be the outcome at that time. But nevertheless, you need something for evaluation. The other alternative would be you only do your projections until in the liquid part of the market and then stop. So it's something. Who knows what is? What we don't agree with is to take the currently visible or available long-term rates that are offered in the market as a basis, and that is related to ECB's policy that tends to compress interest rates, as even considered by Philip Lane from the ECB.
Okay, Siegbert, perhaps we leave it at that for this time. We may come back to that, or make it an extension of that question. But please do ask questions as we go through. And Siegbert, if you could pass the rights to me, I will then start off on COVID-19.
Hopefully, I will be able to find you. I have a lot of names here, and
I think
It's
have
already
done
done.
so.
Susanna's
Thank you,
done it.
Suzanne. Thank you, Siegbert. Okay, so I'm going to speak now about COVID-19, and this, of course, has been a huge issue for everybody, for affecting all aspects of our lives. So we could certainly talk about this for a long time, but I have a window which I must stick to. So I'll cover some aspects and cover it as well as I can in the time available to us. First of all, I want to talk about the status of the of COVID-19. The number of cases is at a high level, as we can see from this graph. But the number of cases has been on a steadier trend recently, and I think as of the 14th, we had 190,000 cases. So we're certainly not seeing it continue to increase at the rate it was, albeit it's at a very high level. We see here the distribution of cases across different parts of the world. We now have 29 million cases, and of those 29 million, Asia is 29%, with India being 17% of that 29. America is 51%, that's north and south, with the US being 22 and Brazil 15%. So we can see, if we take India, US and Brazil, we've got a large part of the total already there. Europe is 14%. And that's of the total cases. Now, if you look at more recent developments, so in September, Asia has increased from 29% of the total to 43%. So in September, Asia is 43% of the total. America has gone down from 51 to 41. Europe has stayed steady at 14, and Africa has gone from 5 down to 3. So we are seeing that Asia is where the growth has been, and that again is primarily in India. I think if we looked yesterday, there were 80,000 cases in India of the 190,000 in total. That's the number of cases. Number of deaths, 925,000 deaths in total. And again, if we look by region, America has 55%, north and south, Asia 18, Europe 23. But in September, Asia has gone from 18 up to 30. America has actually gone up from 55 to 59. So although the cases as a proportion of total in the US, or in America, excuse me, has gone down, the deaths has gone up, and Europe has gone down as a proportion of total, gone from 23% to 7%. Now we know that case counts are really only meaningful if they're related to testing, and so we see very high testing rates in countries such as Australia, Slovenia, South Korea, very low testing rates in Mexico, Nigeria, Bangladesh. And where we have high testing rates, we see a low share of positive tests. Where we have low testing rates, conversely, we see a high positive rate. And the World Health Organization says that the rate should be lower than 10%. The rate of the positive tests should be lower than 10% for to be an adequate benchmark of testing. So benchmark of adequate testing. So and there are not many countries in the world where it is lower than 10%. So testing is a key factor, clearly, in looking at the numbers. When we look then, moving on at the recent notification rates, we can really see pictorially here what I've been speaking about. We can see North America, South America, both having notification rates over 100,000 of more than 120 per 100,000 14-day rates as of the 8th of September. In Europe, we can see France and Spain, and we'll have more of that later, are above the 120 level, and then we also see Iraq above the 120 level. India is between 60 and 120, but it has been gradually increasing and is currently at about 85 cases per 100,000. So very significant concentration in certain areas of the world, and it really is evidenced by that picture. Putting Europe's growth in recent times, the resurgence that we've all become aware of in context, we can see here a number of countries, and Spain, France are at the highest end, but really across the piece, other than Belgium is in here and has fallen away in recent times, but all other countries that we see in that picture. And this is consistent really across major countries. And if we look at the cases per 100,000 in the last 14 days, so the top two, Spain is at 270 cases per 100,000 in the last 14 days. France is at 154. On the other hand, UK is at 51, Italy at 32, Belgium at 70, Germany at 22. So we can see some real differences there across countries. And of course, there will be many differences for those countries, for those reasons for those differences, not least will be the way in which governments and populations have dealt with the issue. So some real differences within Europe and across the world. Looking at deaths and cases, we can see that the cases have increased very dramatically. We talked earlier about being up at the 29 million case level at this point, 925,000 deaths. And if we look at the death rate, that is confirmed deaths relative to confirmed cases, at September 14, it was 3.2%. That's the cumulative deaths versus cumulative reported cases. To the end of June, it was 4.9%. To the end of May, 6.2%. To the end of April, 7.3%. So we've seen it reducing substantially. Now, again, going back to the point about testing, and that's called out here, confirmed counts being lower than total counts. The main reason for that is limited testing. But again, the testing environment really makes this an unreliable measure of mortality risk, because it just does not allow for testing effectiveness. And part of the reason for the reduction in the overall death rate will certainly be testing related, and part of it is also likely to be the spread of the disease into younger age groups. In particular then, when we look at something which could be a more effective measure for us, which is excess mortality, we see with excess mortality that this allows us to understand the direct and indirect impact. Direct in the sense that it captures deaths caused by COVID-19, which were not correctly diagnosed and reported, and indirect in that it captures ways in which COVID-19 has affected health systems and living conditions. So it's a useful way to look at the picture. And the number of deaths in some countries is more than 50% above normal for the period. And we are also seeing a phenomenon that urban excess deaths are higher than other. So if we look, for instance, at two of the biggest cities in the world, London has more than twice normal mortality in the period that was looked at, and New York has more than 4 times. And there does appear to be a particular issue in cities. We can also see some South American countries, Ecuador and Peru, have a particular issue with excess deaths in this picture. So that's the status currently. I'll now move on to the impacts which that has had. And first of all, general business impacts. So economic pressures have been enormous, and activity as a consequence is much reduced. Albeit the way in which it has been affected is itself affected by the way in which governments have responded and populations have responded to COVID-19. Retail, hospitality, and tourism are particularly affected. But if we do look then at the economic position, the OECD in June said that on its single hit scenario, that global economic activity would fall by 6% in 2020, and OECD unemployment would go from 5.4% up to 9.2%. If we look at the EU in its summer 2020 forecast, it talked about an 8.3% contraction across the EU in 2020. But it also mentioned that there were exceptionally high risks to that, and that those risks were mainly to the downside. The risks it talked about were that it was not assuming a second wave. It talked about the risk of company solvency problems, labor market effects, financial market stability, called out particularly the risks emerging from the Brexit negotiations and the potential lack of trading agreement, and also protectionist policies that may emerge. So a lot of risks, and the big upside it saw was a vaccine. But as we know, there's still potentially some time to go to having a vaccine. So significant downside risks, and it talked about an 8.3% contraction. Other features, air travel much reduced, excluding China, where with the rate of new contraction having reduced, air travel has substantially recovered, and equally Russia. Now, that reduced air travel has dramatic knock-on effects onto airports, onto duty-free, onto aircraft manufacturers and lessors, and all of the infrastructure and structure that goes around air travel. As we are witnessing today now, face-to-face interaction is reduced, and there has been a redirection to digital, and that is very much linked to the advent of remote working, which is now very prevalent and is likely to remain prevalent for some time. Unemployment is up, but I talked about the OECD expectation, and we've seen interest rates go down across the world. I give the example of the German rates there. Investment market volatility, investment markets took a tumble between the middle of February and the middle of March. But there's been a strong recovery from the March lows, and in fact, markets are little, if anything, down in total, albeit sectorally, there's a very strong variation across markets. Significant pressure on health services globally, and more about that in the context of insurance and insurance claims experience that we might expect. Big fiscal responses, and that's an interesting thing. Discretionary fiscal responses have been enormous across the world. And we see those splitting into three different areas: immediate impulses, deferrals, so deferral of tax and social security contributions, and then other liquidity or guarantees, such as export guarantees, liquidity assistance or credit lines. And if we look, for instance, at Germany, the most recent number that I saw was that 40% of GDP across those three, immediate deferral and other liquidity stroke guarantee, the total fiscal response to date is costing in the region of 40% of GDP. France, roughly 27%. We also see that some countries such as Germany, UK, US, very high immediate impulse, so very high as a proportion of GDP, lower in many other countries. So again, an example of varied response across governments. Some other factors, clearly for corporates, managing supply chains in this and in this environment is a very difficult, time-consuming, potentially costly. And specifically in the reinsurance sector, it's more a an insurance sector, and it is more an insurance point. There has been capital raising of roughly 20 billion, not all attributable to COVID-19, but we'll come back to insurance and reinsurance. And looking at insurers, the pressures on the non-life side have been mainly in three areas, albeit not exclusively: non-damage business interruption, travel and event cancellation, and the most controversial of those by some distance is non-damage business interruption, where there are significant legal claims underway across the world now, where pandemic exclusions have meant that business interruption has not been included, claims have not been valid for business interruption. And we'll talk more about the involvement of AAE in looking at how that might evolve for future episodes or events. Also, flag the pressures to reduce or refund premiums on certain lines of business. So while the lines I spoke about there have seen significant increases potentially in payments. There have been pressures where, for instance, cars have been lying idle due to lockdowns to reduce or refund premiums on other lines of business. And of course, the importance of digital capability really across the industry has become hugely evident. If it wasn't before, customers are now expecting and routinely interacting with insurance companies digitally, and will continue to do so. And that's been really hastened by COVID-19. On the life insurance side, mortality and morbidity, uncertain as to quite how they'll evolve. Mortality with older lives being primarily affected. Certainly there's an offset with annuities. Life assurance is less affected by older lives having excess mortality. Nonetheless, there will be an impact. Morbidity, I think we can see that there will be significant stress levels. If we look, for instance, at the health sector, the levels of stress emerging from the COVID-19 situation and conditions is likely to be substantial, may take some time to be felt, but I think we can certainly expect to see some claims impacts from that. Retention is a concern where there is a significant economic downturn. There will be a need for money. There will be less money available to spend potentially, and this is related to new business. We'd expect that the retention will be more of an issue potentially with personal than corporate customers, though clearly corporates will also be affected by the economic environment. And with a downturn in new business to be expected, with retention being under pressure, expense will be very much under the spotlight, and efficiency drives will become part of what all companies will be looking at, and will need to be factored into business plans and ORSA preparation as we look forward. Underwriting, we are seeing, I think, some deferral of lives where there has been COVID-19, deferral of underwriting, and also a more circumspect approach to individuals with pre-existing conditions in the COVID-19 environment. And pricing will be affected. Certainly we're expecting to see some increases in reinsurance pricing, which will pass into increases in manufacturer pricing. And lastly here, customer measures, including payment breaks. We have seen quite a few measures, and I think that is something which customers have been expecting and which regulators have been expecting would be made available by companies. For reinsurers, reinsurers will be looking closely at the evolution of mortality and morbidity rates. Annuities will be a natural offset given the age at which we will see excess mortality. The clarity of definitions for non-life lines of business is really important, and we can expect to see pressure from cedents to follow the claim positions. And this is where a non-damage business interruption, for instance, is really important, and the outcome of legal cases will be watched very closely. S&P has put a negative outlook on the global reinsurance sector, expecting the return on capital to undershoot cost of capital again in 2020, and it's only met the cost of capital once in the last 3 years. So the S&P's prospective outlook has reduced. Across all insurers and reinsurers, interest rates, reduction in interest rates, and Siegbert spoke to some extent about that earlier. The operating risk is a factor with remote working and other changes that have happened as a result of COVID-19. And of course, I mentioned investment market volatility, albeit the recovery in investment markets has taken much of the pressure off in that sense. Regulators have been looking to provide latitude in relation to statutory reporting, very focused on treatment of customers, and this relates to the requests for refunds, which I spoke about earlier. The regulators have been looking for companies to be really focused on treating customers well in this environment, and also on capital, the capital position. They asked that companies would not pay dividends. They have stated an intent to be to offer some latitude where there are capital pressures, and they want to understand the stresses and the risks applying to companies. They're looking for more information on mitigating measures in relation to those risks and on financial risks, looking at liquidity, capital coverage, and profitability. So very high level of scrutiny from regulators on an ongoing basis at the moment, and informal contacts with regulators are really in place and open. I mean, they've gone well beyond the formal channels that they would normally deal with in terms of the provision of information and so on. As Siegbert has mentioned, the Solvency II review will be delayed, but that work is still going ahead at a pace. For actuaries, we need to look at the appropriateness of assumptions. I talked about the various parameters earlier. Really got to think about how COVID-19 will impact on each of those, and boards, management, shareholders will be looking to actuaries for some for information and judgment on how that will impact on assumptions. What the impact will be on products in terms of guarantees and customer expectations, implications for budgets, for liquidity, for cash flow, for investment portfolios. We spoke about reinsurance, and the ORSA will be a really important, as we move into Q3, piece of work which actuaries will contribute to. This will be considered in many companies alongside recovery planning, but it will require recalibration of business plans and COVID-appropriate scenarios. Some of those may include single and double hit scenarios. I spoke earlier about the OECD and the EU economic forecast, which are on a single hit scenario basis, and also different shaped recoveries and the outturn if there is a vaccine against no vaccine. So I think the level of scenarios and consideration around scenarios that COVID-19 will require companies to look at will be much elevated this year because of the many different possible outcomes that we can see. Just to flag that we will be doing in the AAE, we will be doing a survey of European actuaries looking at Solvency II in a COVID-19 context and looking at different approaches taken in relation to Solvency II, for instance, in relation to ORSA and some other areas. And Daphne de Laval has been leading this within the Solvency II working group. And we will expect to see that come out in the near future. And lastly, just to talk about the shared resilience solution, which EIOPA is very focused on and the Commission is also conscious of. And this really emerges from the lack of non-damage business interruption coverage, which has put huge strain on businesses which are affected by COVID-19. And there is a quest for a measure which will enable coverage in future, and which may include a combination of insurer, reinsurer, state, and EC involvement. And some of the questions to be resolved on that are around definitions of coverage, how to factor in the different approaches across countries to containment, and whether in fact that can be done effectively, the nature of the risk, criteria for insurability, the extent and proportions of public and private involvement, and how to fund the liability. And the AAE is currently engaging with EIOPA, which has produced a staff paper on the subject, and with the Commission. So, very last point. I think it's really for all of us in thinking about COVID-19, we cannot think that we're going through COVID-19. COVID-19 will one day end and the world will go back to the way it was. That will not be the case. The world will look very different, and it would be inappropriate for us to act with yesterday's logic in considering the issue and the consequences. So I'll leave it there on COVID-19. We'll come back to questions toward the end, and I'll now hand over to Christopher to talk about IFRS 17. Thank you.
Hello, everybody. I hope that you can hear me. Can you hear me?
Yes,
Yeah,
we can hear
I
you.
guess you can. Thank you very much. Now to something completely different, but nevertheless quite relevant to actuaries as well. For quite some time, a new reporting standard for insurance contract has been on its way, and I will give you a short status on where we are at in that process. I'm not able to. Here we go. Just a sec. I will go through 3 items here. I would briefly touch upon the timeline on the endorsement process of IFRS 17. I will provide a short overview of the amendments to the standard since the 2017 version. That was the first version that was published. And I will end talking a bit about the actuaries and their role in the context of IFRS 17. The expected timeline, as mentioned in 2017, the first version of the standard was published, and there was a consultation period, and comments were abundant, and the IASB board went back and have discussed and treated all the comments. And we have now, by June 2020, seen a final revised standard published. And it is the expectation that now we have treated all the most important issues raised after the first publication, and this version, and with these changes and amendments, will be close to the final one. And we will see now a normal due process of the IASB, and almost in parallel or slightly delayed from that, we'll see an EU endorsement process, and we expect that the standard will be endorsed by the EU. We do not know the exact timeline, but it is expected that insurance providers will be able to show or to make an opening balance by 1st of January 2022 in order to be ready for the effective date 1st of January 2023. So this is a timeline, and from experience I can say that there's much to do for most companies in order to get there in time. So I would expect that most larger companies have initiated their initiative and is on the way. Now I will briefly go through the amendments that is in place or has been published since the first version of the IFRS 17. There are some general changes. There are some changes that are specific for life and health insurers. There's specific changes in relating to combinations and portfolio transfers. And for non-insurers, there's a scoping change or clarification in relation to credit card and loans that could look similar to insurance contracts. And there's a number of small amendments that I will not go through in details in this meeting because we wouldn't have time for that. In terms of the general changes, I will go through those one by one. The first one is a simplification. The standard requires insurers to present contracts that are assets and liabilities separately, but this separation is no longer required on a group level, but on a portfolio level, which means that you can do it on a more aggregate level. And since most portfolios of insurance contracts would generally be expected to be in a liability position most of the time, this is a significant relief to most companies in practice. So I guess, thumbs up, that's a simplification to a complex standard. Generally speaking, the IFRS 17 standard has a non-symmetric recognition of profit and loss. Losses needs to be recognized immediately, whereas profit is recognized over the contract coverage period of the contract. And here's a change to that in relation to reinsurance contracts. If you do have a group of contracts that are onerous and you expect to earn money on a reinsurance contract covering this business line, you are allowed now to recognize the gain from the reinsurance contract at the same time as you recognize the loss on the direct business. And by this, you reduce the accounting mismatch, which should be an improvement, or considered an improvement for looking at it by the view or the eyes of the industry. Insurance acquisition in relation to one-year contracts that are usually renewed, like most general insurance contracts. There's a clarification here where you're now, or a more flexible way of taking in the acquisition cost of a new contract. That if you take in a group of contracts and you expect to renew most of them over 1 or 2 or 3 or 4 years, you are now allowed to spread the acquisition cost over time, which means that you can avoid having a onerous first year of these type of contracts and then profitable contracts in the following years. Of course, you're required to have an allocation that is systematic, that is based on modeling, rational modeling, and you should be able to follow up that you actually that these renewals actually occur. So it's subject to a recoverability test, and this would allow to spread acquisition cost over time in sort of more logical way, seen from a business perspective. This is a way that you would consider writing new business, and it looks a bit like a DAC way of looking at acquisition costs, and I guess that would give a more consistent results over time for general insurance companies. When it comes to interim reporting, the original version of IFRS 17 required insurers to use a period-to-period approach, and which means that you log in the results of the first period when you start on a new period, and it had the consequence that the frequency of interim reporting had an impact on the contractual service margin and the revenue in the annual financial statements. And with the amendments, it is now allowed to use a year-to-date measurement process, which means that you have more consistent results over the year, and it's easier to explain the end-of-year results and the contractual service margin. So first of all, the increased flexibility means that you are able to choose a method that fits the purpose, but especially for companies who publish quarterly and half-year results, it's a significant relief, and it provides more natural results, I would say. Looking into the changes that primarily apply for life and health insurance, there's the definition of coverage units, which means that the definition of when the services of a contract takes place has been altered a bit, so that for insurance contracts that contains both insurance and investment related services, the new definition of insurance contract services includes both the investment return and investor relation services, as well as the pure insurance services. And especially for like savings contracts with an insurance element in the accumulation phase, but for instance, no insurance element in the decumulation phase, would see a more natural and smooth recognition of the profit of this contract over the total span of the contract. Risk mitigation. The risk mitigation option means that you are able to, under certain circumstances, to use derivatives to reduce risk, especially on direct participation contracts, so that you can use your asset side actively to reduce risk in your balance sheet. And in the 2017 version of IFRS 17, it was permitted only to use derivatives to mitigate financial risk. But this option has been extended both to reinsurance contracts and to non-derivative assets measured at fair value. And these extensions means that you avoid accounting mismatch. So again, that's an increased flexibility, and it serves the purpose better than before. Sorry. Level of aggregation. This is an issue that has been controversial ever since the publication of the first version of IFRS 17. The standard requires insurance companies to split portfolios of contracts into annual cohorts based on the date of issue, and especially in life and pensions, and especially when we see contracts with some mutuality features in them. Many contracts in many places actively have mutual features that goes across different annual cohorts, and splitting up the business in annual cohorts doesn't fit the business logic below. Unfortunately, I'd say the IASB confirms that the annual cohorts are necessary in order to provide useful information about profitability of groups over time. That the idea is that you can follow trends in profitability over time by looking at annual cohorts. It's a significant and complex feature to establish for most life insurance companies, and I think it's fair to say that the industry had hoped for some relief on this requirement, especially for certain types of contracts with mutual features. It doesn't seem to be changed, and I think the issue has been discussed now for 2 years, and the IASB seems to be firm on this issue. Again, for life, the use of VFA, variable fee approach, under the IFRS 17, it wasn't clear whether how to assess whether a contract could be reported using the VFA, or you should use the general method. And the IASB has confirmed that you need to assess the eligibility on a contract level, and it cannot be done on a group level. So it may be more complex in practice, but at least it's a clarification. Business combinations or portfolio transfers. Again, this is a clarification that the board decided to retain unchanged the requirement on insurance contracts acquired in the settlement period the traditional reliefs were confirmed, but some of the pre-IFRS 17 exemptions to identify where it was possible to identify a contract, insurance contract based on fact and circumstances at the original inception date. This is no longer the issue. It has to be done on the acquisition date. So again, it's a clarification, but it's less flexible probably than some might hope for. Finally, the scope of IFRS 17 has sort of de-scoped certain credit card and loan agreements that had features of insurance contracts. If a non-insurer provide these services, they are not supposed to be reported under IFRS 17, which means that banks and other providers of credit cards and loans can avoid using IFRS 17. This is probably less relevant for actuaries, but anyway, it's a clarification. And then there's a number of other transition reliefs and minor amendments that actually quite a lot of them, and I will not go through every single one of them, but I just want to mention that it is important to update the view if you've started your IFRS 17 journey based on the 2017 version of the standard. It's important to be aware of the amendments and the changes along the way. Finally, I will just touch upon actuaries and their role under IFRS 17. Within the AAE, we've had a number of discussions on this issue, and I expect that the AAE will publish a paper on its view on IFRS 17. But what I will mention here is that what we've seen under Solvency II is that the actuarial function has a formal responsibility on the life provisions in under Solvency II. And now we see a statutory accounting standard that uses what I would call Solvency II equivalent skill set in order to establish the fair valuation of future cash flows and the fair value of insurance liabilities. So what we see is an accounting standard that requires much of the same skills as Solvency II. And to me personally, it's kind of a surprise that an actuarial skill set and an actuarial function is considered a good thing to have under Solvency II, whereas under IFRS 17, actuaries have no formal role. Nevertheless, I would expect that in most insurance companies, the actuaries, especially when it comes to long-term contracts, actuaries will have a central role in the statutory reporting process. And you will see that much of the data flow and the calculations are similar to what we see under Solvency II. And on the other hand, actuaries, to some extent, needs to get acquainted with audit trails and the data flow and the governance that goes with data going into the disclosure and to the reporting process. And I see that accountants and actuaries need to cooperate much closer than we've probably seen before in most countries. And it's my personal view that accountants will not be able to provide high quality IFRS 17 balance sheets without the help of actuaries. And on the other hand, I don't think actuaries should do the reporting by themselves. So this standard really requires a good relationship and good cooperation between the two professions. And I can only encourage actuaries to get involved and get acquainted with the IFRS 17 and to make an impact in the companies where you work and show that you can contribute to the process and to high quality reporting. I guess that would sort of be my personal take and view on IFRS 17. I see that many companies, from my daily work, I see that many companies are quite far in the process, but the other companies have only started, and there's a lot of work to do to understand it. It's not going to be simple. I guess that was what I had brought for today, and if you have any questions, you are, as Tony has mentioned, you are able to send them on in the chat room, and we'll take them afterwards. I will give the word back to Tony.
I think you probably pass on to Lowry, actually, Christopher, if you could.
I can pass on to Lowry.
Yes, that would be great, and thank you very much. And as Christopher says, please do think about questions that are on your mind and put them into the chat room, and we will deal with them when we get to the end of the presentations. I see we do have some, but it would be great if we can get some more. So please do enter your questions into the chat room. Thank you. I'll hand over to Larry.
Thanks, Tony. You hear me well and see my presentation?
Very well, and yes.
Thanks, Tony. So, hello everybody. Larry Saste, and I will talk a little bit on the development on sustainable finance. Certainly, what has been going on and happening in EU, and what might be kind of the major steps there, and maybe question marks also. But I will also have a couple of slides of different matters considering actuaries and the work, and also kind of the new skills that might be needed. I think that might be an interesting topic to talk about. Please put any questions you might have, and I'm quite certain actually that we will have time in the end, as Tony mentioned. So maybe as an overview, as we know, this is a kind of a big topic in the political scene. Sustainability is kind of widely talked. It's also a lot of kind of media around that subject. So I think we are quite aware of the main things here. Maybe as a reminder, we have, and what the EU is strongly supporting, is that we have kind of the United Nations 2030 agenda and the sustainable development goals in the back, and we kind of have this as one of the setting. We have the Paris Climate Agreement, which mainly says that there should be a 40% cut in greenhouse gas emissions. So, and this is a big kind of goal to have. We already see that. I think one of the implications obviously is that there is an investment gap, nearly 200 billion per year, which certainly sets the scene for many of the EU's kind of hopes for the change and what might happen. We have the European Green Deal, which I have an own slide of that, and there is a lot of steps in that kind of policy and what the EU is trying to achieve. Part of that is certainly the investment plan, which came out this year, which will try to mobilize at least 1 trillion of sustainable investments over the next decade. So we are talking about quite big numbers. In EU's policy context, and I think these are important to kind of to understand that sustainable finance is understood as finance to support the economic growth while reducing the pressures on the environment. So I think there's certainly, I think it's quite clear that we will need the kind of new investments taking into account these new aspects, and that would be an important thing to bear in mind. Then we have the European Green Deal, as said, and certainly also kind of the private investment side is part of that, and that the transition there to climate neutral, climate resilient ways. Going more deeply to the Commission's action plan on financing the sustainable growth, we have the following steps, and I think we are quite, I think these are the things we have heard about. There's lots of kind of more deep subjects in each of these, and I will touch upon the taxonomy and the green bond standard a bit more kind of in detail, but we see that I think there's certainly a lot of steps that and from these we see that the EU is trying to achieve a lot. The taxonomy itself is a kind of big new puzzle of definitions and ways to trying to bring more kind of understanding on what we are trying to achieve, certainly from and taking the green aspect. I think that's certainly the highlight, and then the green bond standard is coming aside when we have the taxonomy. But on the other things, we are certainly the Commission's idea is to foster the investment in sustainable projects. This will have an impact in financial advice. We need the sustainability benchmark there, and that's an own separate big topic actually. We know that there will be things to deal with on ratings and market research, and also asset managers will have new kind of duties regarding sustainability. EU has talked about kind of introducing a green supporting factor when it comes to prudential rules, and this certainly will also affect Solvency II, even though at this point we are quite kind of unsure and there's no decisions yet, but we can come back to that. The disclosure has been seen as one important part where more data can kind of be created, more publicity can come after companies publishing their reports and the ways their assets and balance sheets reflect the certain sustainability measures. Then we'll obviously we have a corporate governance and this kind of short termism, which is something that EU is looking on, and as we, I think it was already in Sigbert's presentation and Tony's, that there is a kind of the hopes on the EU capital market side and what would be the consequences there. EU has done a lot, and there has been a number of expert groups, and because of the expert groups, I think via the expert groups, a lot of good work has happened, and I think we are where we are because of that good work, and that these have certainly a big impact, and obviously this is something that the EU is continuing. We have the reporting is something that we are already seen the ideas of how the reporting, what kind of sustainability reporting should start already next year. We have those plans, and AAE has actually been quite active on responding on those. So there's links on to AAE website where you can find some more material if interested on the sustainable finance strategy and on the reporting side. Taking maybe a bit more, going a bit more deeper on the taxonomy, even though this is a really big subject, the taxonomy is highlighted as one of the most kind of important parts with what we need to enable the other work, and I think that's certainly why there has been so much work on taxonomy. But one needs to kind of, you can see it from the right hand side, the taxonomy is still touching on 6 different subjects. So obviously there is a lot of parts where taxonomy is not yet talking anything about. So it's more on the kind of looking on the kind of on the deep green sides of different actions. And therefore, there would be already in the pipeline, there is plans to increase the taxonomy and to deal with other subjects also. But I think this is a big part of the work to try to define and understand, even for these small subgroup of green actions, that what they actually mean and what it means if somebody is financing or investing into these. Going further, the other part is the green bond standard, which is under development, and I think this certainly uses and tries to align with the taxonomy. So certainly we need the taxonomy groundwork to make the green bond standard work. But then the idea is to have this kind of green bond framework to be produced by the issuer, the required allocation, and obviously we need the reporting, and there will be a need for external verification. But as we know, investing into bonds is a big part of what institutional investors do, and what's in the investment strategies. To have the green bond standard in place will be one of the big goals in the way, or in the EU's plans. Maybe a word on sustainable underwriting. This is certainly a part of the work which might consider even more actuaries than the sustainable finance side. As we know, insurers are really close to ways societies work, and any change in societies will also change the needs for insurers. We are really close on the public-private matters here, and this is certainly one of the key kind of things what needs to be dealt with. We are talking a lot on the climate change side, but obviously the social responsibility and good governance, the S&G of the ESGs, is important, as we know that good governance is something that changes in time. We are today talking about more transparency. We have the gender and age balance matters, and so on. On social responsibility side, obviously companies might need to offer more products to wider range of customers. There might be kind of growing pressure on how to deal with issues around information and technologies, and as we know, the social media is something that will take care of if there is a kind of not dealt properly. Obviously, social media is a good way that takes care of things going public, and might put put pressure for companies. But anyway, just to mention that the climate change is certainly the big thing, but there is also other matters on sustainability. We have an experience on cyber risk as a kind of a new way of how companies, insurance need to think about, are they able to provide that cover? Would they need kind of some reinsurance there, and how they are dealing with that by themselves? I think there is a lot of similarities to sustainability, even though obviously cyber risk is a kind of a much more kind of a smaller thing. But just to mention as an example, the other thing that companies, we know that in the asset side there has been many insurance are doing a lot on sustainability. The principle of whether to exclude, whether to avoid, and where to invest in, I think that's a principle that have been developed a lot in asset side. This similar type of thing obviously connects quite closely to insurers, as for instance, P&C insurers have had to decide for long what kind of risks they are underwriting and what not, how to price, and whether there's an involvement of a third party. So it's more on the risk side than might not be on the customer side. As we know, the question of avoiding investing or avoiding underwriting is certainly different type of questions. There is a lot of insurance covers that might be mandatory to provide. There's legislation behind it. Obviously, there will be discussions on what kind of changes the mandatory product lines need to face, and obviously whether some of the covers that are provided in the public side would be more on the private side in future. Okay, going further, we have maybe another development. I think we have seen already that in globally 10% of premium income, if you by premium income, if you measure the companies have been complying with the PSI principles, and this is certainly a growing number. There might be more pressure in the future also for bigger group of companies to comply with these principles, although the principle itself might change. Nowadays, there's 4 kind of main things under these principles where kind of companies need to integrate the ESG issues into their risk management, underwriting, and so on, to the way of the company does business. They need to develop products and services which reduce risk and have positive impact on ESG issues. They need to support prudential policies, and they need to kind of have a good dialogue with governments and regulations, and participate in the relevant disclosure and reporting frameworks. And when the interest is growing, obviously more companies are taking part of it. There might be this, as an example, might be one thing to increase the pressure for companies to change the way they are doing, and seeing that they, for instance, if they have investors or if their policyholders are kind of demanding of this or similar actions. So this might be one of the game changers a bit. Then going a bit on the scenario work, we know that there are already soft requirements for actuaries and risk management on taking into account the sustainability related matters. And then obviously, if we have in the law that in the best estimate calculations, or there need to be some this need to be dealt some way. Obviously, it might need some modeling, and modeling is data and understanding. So certainly there is a software requirements also. Also, in some countries, there is more detailed requirements on how to deal with sustainable in ORSA, and that will change as we know more about it. We get more data, more kind of understanding of the different future scenarios, and then kind of comes the ability to bring more this on the scenarios. We have, I think, right now there is a plan, there is the consultations on the EU stress test. I think this is the second consultation touching also on the sustainability matters. In that paper, certainly one topic for actuaries to consider is the scenarios and the length of scenarios and how to deal with this. I think this has been left open in the paper, but certainly might be a topic which would affect a lot on the scenario works to be able to provide answers to the stress test. But let's see what comes out next year. Then also new ways to model the impact of the risks. As we know, the balance sheet and its risk profile there is a lot of different risks that will affect the balance sheet. What are the most important ways of, for instance, climate change affecting the balance sheet? Do we understand the different risks and maybe options that our policyholders have, or what we have towards them or in our investments? I think it certainly needs a lot of understanding to have a good model on how to take these new, for instance, climate change into account. They already is providers of these scenarios, and certainly help might be needed. Obviously, there's lots of new understanding that needs to kind of be created, and therefore also those who have been doing this and offering any help, that might be kind of people to talk with. Obviously, we have a difficulty also here, as always in modeling, on how different matters are connected. We kind of touch upon the changes in societies. What changes in societies or in the investment markets obviously has a big impact, and also wide impact to companies and their balance sheets. And therefore, I think that's an important aspect, which is certainly something that we only kind of learn more in future, and certainly need a lot more experience on creating this understanding. I would mention the actuarial climate index. There was a good article published by the Society of Actuaries in Ireland, which you can obviously read that article. But anyway, it goes kind of well through the development on the actual climate index, and which has been starting from the from North America and some development in Australia, but now there's a lot of work going on in Europe to make this kind of European actual climate index. There is, as we know, when there's a need to price or understand the risk profile or make scenarios, these type of indexes are certainly really useful, and this was just something I would highlight, but I won't be going more deep to this one. As an end slide, maybe kind of summarizing some of the points, and certainly why this might consider actuaries the work on sustainable finance. We know that the investment side has a lot of developments going on, and certainly this will make will change the way insurers needs to deal with sustainability matters, even first at the asset side, but then certainly more widely in the way insurance is provided and the companies managed. So that would bring, I would say, a big need for actuaries also to be more aware of this. The actuaries have usually also been really closely related to different reports and any new reporting requirements would need at least some actuary work, I would argue. In Solvency II, as said, only software requirements now, but obviously there will be a discussion going on what might be the next steps, taking into account also the scenario work. Then I would point out the requirements relating to information provided to customers. We have the PRIPS and IDD, and by now there is no kind of requirements on sustainability, but certainly in the future this will be put more on the as a customer decision point when buying the savings or pension or even a non-life risk product. And then as said, we need more general understanding of this new topic. We as actuaries are experts in our fields, and certainly companies need a lot of expert arguments on how and in what ways the sustainability matters will need to take into account. We are professionals when it comes to pricing, reserving, ALM and risk management, and I think that certainly will be a big part of the work and make us will highlight the need for us to understand more the subject. I think this was the presentation. Tony, I'm done. I would maybe put back to you.
Thanks, Larry. Yes, if you can do that, that would be great.
Here. Yep.
And okay, so I will then. I'm taking it from here. We have quite a few questions to look at this point. I actually have the camera on, but it doesn't appear on the screen. Not that that's the end of the world. So I will go into the questions.
We can see you.
Oh, you can. Okay, it's just I couldn't. That's great. Thank you very much. I'm not sure how much benefit that is for you, but all right. Let me just go into the questions if I can, and we have quite a few here. So I'll start with a question. If you don't mind, I'll mention the name of the questioner and put the question then to the relevant person. So we'll also try, if we can, for the presenters to be concise in our answers, because there is quite a few questions and we are limited on time. First, hear from Michelle Neary in relation to Solvency II. Sigbert mentioned AAE does not support a change in the last liquid point or a change in extrapolation methodology for the euro. What do you currently expect EIOPA to recommend in December? Is that something close to what's in the complementary holistic impact assessment? Also, do you expect them to include the lambda factor in the risk margin, which was something of a surprise to the industry when it appeared in the impact assessment? Sigbert.
Yeah, I don't have a crystal ball, I have to confess, but nevertheless, I think asking this question and asking the undertakings to provide the data is at least a strong indicator that something is moving. I would say, first of all, the easiest question to my mind is the question relating to the risk margin. I would expect to have this factor included. And one reason for this expectation is that I think EIOPA will tend to develop a whole bundle of measures, but will not tend to overstretch undertakings. So I would suppose that the risk managed margin, they will stick to this factor that is now tested. What I don't really know is the question relating to the extrapolation. I think EIOPA has been keen in changing the methodology to the alternative extrapolation, but I'm not quite sure. I don't know the outcome of the impact assessment. The complementary request, the undertaking, EIOPA will have the data by 24th of September. So I think they will also try to take into account the result of this holistic impact assessment and then make up their mind. I would not be surprised if EIOPA proposed this alternative extrapolation methodology, but I'm not sure what will be the final outcome. The one step is the what EIOPA will do, and and see how close we stay to these scenarios that are tested by now.
Thank you, Siegbert. Hopefully that gives you an answer. Michelle, just a question from Gabor in relation to data. Do we have a concern around the consistency of COVID-19 data from all around the world or even from Europe? And I think the answer to that is that there is a generally held concern around data. Certainly all of the data that I've taken is from the European Centre, the ECDC, and from the FT. And they say, the ECDC says that all data should be used with caution and awareness of limitations, and it is subject to retrospective corrections. So certainly caution and awareness of limitations implies that it would not only be people on this call that might have concerns around data. So that's that question, Gabor. That was unplanned. Okay, then the next question is that we'll deal with is on from Lustabor. What will be the impact of the change in methodology of the calculation of the risk margin on the longevity reinsurance market? Siegbert, would you deal with that?
I don't know exactly if the impact will differ between special kinds of markets. I think it will have an impact on long-term business, and the longevity reinsurance market, I don't know exactly how the calculation works in this case with this specific topic, but nevertheless, reducing the influence of future SCRs will end in a reduction of the risk margin. So sorry that I don't know more about this specific business, but that is my expectation here in this case.
Okay, thank you, Siegbert. Question or a comment actually from Ksenia around the IAA having recently published a very good document regarding the role of actuary under IFRS 17. Christopher, just a question for you around how you think the role of actuary will develop.
I'm aware of the document of the IAA that essentially recommends actuaries to have a more formal role in relation to IFRS 17, and I believe that the paper that is on its way from the AAE is even more specific in relation to Europe and the context of Solvency II. So I see that the paper from the IAA and the paper expected from the AAE are consistent with each other and with more or less the same message. I've been involved in both.
Okay, thank you, Christopher. And I guess then the question is the extent to which the recommendations and thoughts in those will be taken on by policymakers in relation to IFRS 17, but that's to be observed in the future.
Yeah, but I think the difference is that the AAE speak towards a specific legislator. I mean, towards the EU and EFRAG, whereas the IAA cannot talk to specific legislators. I mean, they're talking broadly in a global perspective.
Thanks, Christopher. And on the subject of IFRS 17, Christopher, what are the largest IFRS 17 related challenges for non-life insurers?
Probably in relation to reinsurance. I would say that the Solvency II is based on a net valuation, whereas IFRS 17 goes on a gross and reinsurance separately.
Thank you, Christopher. Laurie, on sustainability, where you say sustainability is to be included in financial advice, this is from Florin. What does this actually mean? Can you give an example of such an advice and why a financial advisor would give such advice? What mechanism is there to encourage financial advice to support sustainable investments?
Yeah, certainly. I don't know the specifics on what has been discussed with those kind of financial the part of financial sector which provides advice, but certainly I would see that there is a relation to what had been discussed on what kind of advice is given to insurance customers, and I think this certainly touches the point that I had on the proofs and the key information documents, and the needs there, where obviously part of the EU's idea and is certainly to have a proper discussion with the consumer when making the decision to start the savings or pensions plan, and therefore I would say that there is a need to be a lot of understandability around the subjects. Also, the customer needs to understand on what kind of a investment decision he or she is making, and then we would be also talking about, for instance, how it relates to taxonomy, or what's the time frame and what's the risk profile and so on. But this is certainly a big subject with a lot of unsolved issues. Tony.
Thank you, Larry. I'll take a couple of questions now on the COVID-19. So, Alexander, have there already been statistical analysis about the excess of mortality rate with an adjustment for effects in other causes of deaths, e.g. decrease in motor death due to less traffic and more home office, and increase perhaps in suicides or stroke deaths? And I think the short answer is that in the information that I have provided or have seen, there has not been statistical analysis which has tried to adjust for the effects of changes in other causes. For the Financial Times, it talks about deaths observed in excess of the historical average for the same period, and the ECDC data is based on the number of weekly deaths in 2020 compared to the average of the number of deaths in the same week from 2015 to 2019, so over the last 5 years. So there is no adjustment to the base. So that's the answer to that question. Then Florin asked a question around capital raising. Do we know roughly how much is equity versus debt? And from the analysis I saw, about 45% was equity, about 30% debt, and the rest was startup funding of various types. So 45% equity, 30% debt, and startup funding. Okay, a question for Siegbert, actually, although I think it's a question which goes beyond the Solvency II working group in many ways, and a very interesting one from Nick Dumbreck. If there is so much uncertainty over interest rates beyond 20 years, despite a deep and liquid swap market at certain terms up to 50 years, should EU-based insurers be writing business with terms exceeding 20 years? Is there not a danger that new long-dated liabilities will create artificial own funds? Siegbert, what's your thought on that?
Yeah, I think that is a really good question, and I think we see some responses on this question, and also contained in the review paper of the Commission. It is, of course, a risky situation where you give guarantees for long-term contracts. And here we have to differentiate between business, between portfolio in force, what we can't change, and we can look at new business written. And the new business written, I think it's mostly in line with Solvency II requirements, but it has to be assessed and it has to be discussed with politics if this business is suitable to give, to provide a protection to people as they might need or they might ask for. And I think that's really what you can't do today. And I think that's a movement that we can observe. You can't give guarantees that last for such a long time. And a special risk, a specific risk is business that you write with regular premium payment. And I think that is also one of the big threats now for the conventional insurance business in the life insurance undertakings. They have published, they have sold tariffs with a guaranteed interest rate of 3.5, 4%, and they are now still receiving premium on these contracts, and they have to stick to the guarantee. So I think what the lesson learned here is that such products should not be possible in the future. And I think this is an issue. It cannot be changed immediately, but I think it's on the way to change.
Thank you, Siegbert. And I think we also, clearly the customer would have something to say about us restricting the term of product we sell, but it's a very important issue for us. Moving on, if I may, to a question for Lauri on one of your slides, Lauri, you mentioned green supporting factors for EU prudential rules. How briefly, if I may, how developed is this idea and how does it sit with the market consistent basis of Solvency II?
It's certainly not kind of still under discussion. It's a kind of a hot topic because we don't know the data, and this would, for instance, talking with EIOPA, they are really kind of they can't. For them, it's hard to kind of be kind of suggesting something where if they don't have the data. But I would also point out the maturity, kind of the risk horizon, because in Solvency II we have a 1-year risk horizon, and with sustainability matters we might kind of look the risk like 5 to 10 years, and therefore we are really in different scene that what we currently have in Solvency II.
Thank you, Larry. Thanks for that. Christopher, on IFRS 17, on that question around where it will go and the endorsement process and the role of actuary, any last thoughts on that?
No, I think that the AAE should engage in the endorsement process of the EU, because we do have some structures in place, for instance, in relation to an appointed actuary, or in a pan-European context, the actuarial function, where I think that there is some space for actuaries that requires more formal responsibility. And I hope that we can take up that challenge.
Thank you, Christopher. Lots of work to be done on that front. I have one more question, if I may, for on Solvency II for Siegbert from Florin on EU stress test 2021. Is the AAE already engaged with EU institutions, or is it wait and see for us?
I think the engagement, if you look at this new discussion paper of the EIOPA with regard to methodologies for stress testing, I think we are trying to comment at least on this paper, and I would expect some of the issues discussed in this paper will also can also be seen in the stress test for the year 2021. And that's why we are aiming at finalizing our comments. I think deadline for comments is 2nd of October, and I would expect EIOPA also to take into account the feedback, the comments received on this paper on the methodology.
Thank you, Siegbert. So I think we've come to the end of our time. We had quite a few questions there, and I know we've had to go through them fairly quickly, but hopefully you've got a sense of the views of the presenters for those questions. I'd like to thank Siegbert, Larry, and Christopher for their presentations and for the work that went into them, and for you for attending, listening for the 2 hours, and for your participation by way of question. And I hope it fulfills the objectives you had of these 2 hours. So many thanks, and also if I can say thank you to Monique in the AAE, Suzanne Cada who was a great help with getting the technology set up, getting us moving along, and thank you very much. Goodbye.
Goodbye.
Thanks, Tony.